this computer.
Yeah, so now you'll get it. All right, well, thanks again. I'll start one more time just so you guys have it on recording, so you'll know what it is. So,
Thanks.
yeah, no problem, man. All right, so if you want to know more about infinite banking, like I mentioned before, go ahead and grab the book from Nelson Nash, Becoming Your Own Banker. YouTube, just type his name in, learn from him or anyone that was taught by him, and just go from there. Just get your foundation first, then start listening to other content if that's what you want to do. But understand, infinite banking is not a product. There is no infinite banking product you just buy on the shelf. It's not an investment, because an investment classifies risk, like a stock, a bond, a mutual fund, and whatever it is, right? It goes up and down. There's absolutely no risk in the infinite banking concept utilizing the dividend paying whole life policies. Okay, so these are dividend paying whole life policies that we utilize for the infinite banking concept because it's a process. And we use whole life, but we only use very specific policies that are issued from mutually owned insurance companies, not stock owned companies. Okay, and these mutually owned insurance companies have been around over 100 plus years and never once missed a dividend payment ever. Through any recession you can think of, you got a dividend, no matter what. If you don't know what a dividend is, when you put money or premium into a mutually owned company, you become an owner of the company, meaning you participate in the profit shares in the form of a dividend. So a dividend, by definition of the IRS, is just a return of your own premium. I don't care how they classify it. If it's tax-free, just give it to me. I'll just take it. I don't care. The difference with stock-owned companies, they aren't just shareholders for profits, which means when we take the ups and the downs in the market, the swings, our 401ks, IRAs, mutual funds, all this stuff, who still makes all the money? The board members. So I'm going to stop giving them my money. I'm just going to focus on things that I own and control. So that's why I work with mutual companies. Now, a lot of people have seen these famous people: Walt Disney, Ray Kroc, and McDonald's, J.C. Penney, the Rockefellers of the day, and presidents. These individuals have been using the banking concept for 200 years. Without knowing it, it was through whole life. Okay, it's not through any other types of life insurance or cash value policies. It's whole life. And I'll explain the reasons why in a minute. When you're dealing with whole life and you're asking yourself, who are one of the finest institutions out there that have money and make money? Well, I think banks are one of the top ones that know how to analyze risk. So if you don't know, you can look this up. BOLI's, bank-owned life insurance. You will find that banks put their money, about 13 to 37% of their money, inside of whole life cash value policies. That's what they do. You know, like they don't put it in universal life policies because they don't want to reach for the stars of maybe making something out there in the future, whether it's a sub account or an index. They don't care about that. They want certainty. They want guarantees. That's just how a bank runs. They can't take speculation. Now, a bank can't own life insurance. A bank has to have a body to insure. So the bank puts premiums on their vice presidents or their executives, where the bank pays for those premiums. And when the bank wants to overfund that as much as they can, the bank has access to borrow that money tax-free from that employee's policy to go buy the biggest, tallest buildings in every major city. Also, when that person passes away, the bank will reclaim that death benefit tax-free on their balance sheet. Now, another reason why banks use whole life, specifically whole life, is because in order for the bank to get a tier 1 capital rating from the Fed, they have to have a certain amount of money on reserves as guarantees. Well, the only place you can have a guarantee is in whole life. The majority of it, guarantees and dividends with certainty. So that's why they put their money in cash value whole life policies. Now, if you don't know how banks make money, you're going to find out today. Banks don't have money. Banks wait for you and I to make deposits. And now when the bank has our money, the bank can go lend our money out to other people who want a home, a car, remodel their kitchen, or pay high interest credit card debts off like I did. They lend our money out, charge everyone an interest rate, and they get the spread. And that's why banks are making 500 to 1,300% on the backbone, sweat, labor of us. And they do what for us? Give us less than 1% in our savings account? It's pretty nice of them, right? So I want to educate and teach people how to do exactly what the banks are doing. Now, we may not have billions of dollars, but if we have hundreds, thousands, hundreds of thousands, we just got to start somewhere. But these whole life policies have to be designed, specifically engineered. They have to be designed properly. It's not your traditional whole life like your broke brother-in-law that just got his license. Or Dave Ramsey and Susie Orman talk about how traditional whole life is trash. We don't design it that way. So just to let you know. Now, going forward, we are one of two people. Everyone is doing this or have been doing this in their lifetime up until now. You are either the person that finances, where you go down to the dealership, you go get your car, you pay for 5 or 6 years. Who are you paying that money to? The dealership, the bank? And now after 5 years, you got 100,000 miles on your car. You missed that nice leather smell and those crumbs are creeping up the seat. And guess what you got to do now? You got to go get another car. So you do this over and over again, every 5 or 6 years. You give your money away, get nothing in return. Or you like my father taught me to be a saver, where you save your money. And now when you have enough money in your bank account, now you just write a check. And the reason why people use their cash is because they don't want a payment. My father was wrong, because you do have a payment. The payment may not be back to the bank or the dealership, but I got to replenish the cash that I just spent in my savings account, which means now I lose the opportunity cost my money could have been earning somewhere else, because that can take me 5 or 6 years to replenish 40 grand if I put it down a car. And now I could have been earning somewhere else by borrowing somebody else's money. So you're either the person that saves and spends or borrows from other people and gives it right back with nothing in return. We're going to train you and teach you how to do what the wealthy corporations and banks do, where they put money into these specially designed policies, where you can put money into it, accumulate it, and then over time you can borrow money tax-free from the insurance company while your cash value sits there and grows untouched, uninterrupted for the rest of your life. And that's how you become a bank. So we're going to talk about a car today, because we all drive and we're going to drive. If you take this Jeep for $35,000 at 6%, if you're lucky enough to get that interest rate today in this environment, that's your payment. At the end of 5 years, that car is going to cost you an extra $5,600 extra dollars. And now you got a car, depreciating asset, and nothing in return. And you might have to go get another car, depending upon where you drive. Or you can get a specially designed and engineered whole life policy that I know how to design, that Neil knows how to design, that everyone's going to know how to design, where let's just say you have a lump sum. You can put a lump sum into this policy immediately, like 60,000, 50,000, take it right back out within 30 days to go get your car. But let's say you don't. Let's use a 30-year-old, which the age is irrelevant. Could be a 40, 50-year-old. It doesn't make a difference. But for this example, we're going to use a 30-year-old female, standard on tobacco. She goes ahead and she takes $10,000 from her savings account that's doing absolutely nothing. She repositions it right into the policy to supercharge this thing. And at the same time, she's going to pay $500 a month. And now in 5 years, that money has accumulated to $37,540. And now she's going to go ahead and call the company or click the button that says request a loan. And she's going to borrow $35,000 tax-free from the policy. I want you to understand, she's not borrowing her money. She's borrowing the insurance company's money. Her $37,000 is still sitting right into that account, locked in a vault and growing at the full value. So now she was going to spend $676 anyway to the dealership every month, or she was going to spend $676 to her savings account to replenish her cash. We want to teach you to take the $676 and pay it back to the insurance company for lending you their money. And at the end of 5 years, that loan is completely paid off to the insurance company, and your $35,000 has been sitting in there growing, untouched, compounding every year for the next 5 years. And now you have made a $4,000 profit for borrowing other people's money while your money was sitting in your account growing untouched. That's how you become a bank. And I'll answer some questions and simplify this later on, after we're done. You can also do tax-free lifetime income with whole life, just like you can with any other types of products out there that you have. It's just on the design, the structure. Now, when we design whole life, we're not designing this banking concept for the death benefit. So we don't want a $500, $300 million debt. We want the lowest amount of death benefit we can possibly apply for, so we can do what banks do and maximize the cash and overfund it to the max, at least underneath the threshold of the 7-pay MEC test, so we can take advantage of the tax-free benefits. So this slide I use now because I think people forget about what happened in 2009 when Time Magazine did an article about 401ks and how they're not really meant for us. They're kind of like washed up. They were really created from a gentleman named Ted Benna, who even came out and said publicly that he was wrong about how this was designed for retirement. This really wasn't meant for retirement. It was a supplement. But this was a way where corporations who have thousands of employees can go ahead and write that whole thing off. And they get us by allowing us to have a match, which I consider bait. They baited us. It's a bait and switch. Because any monies that go into a 401k, you've now locked yourself into the government shackles, because if you take any money out prior to 59 and a half, you're going to pay a 10% penalty plus ordinary income tax. So they've locked you in. And every time you make a 401k contribution every 2 weeks, you don't even have control of your money. Wall Street does. You get to pick and choose what they say. So now you're kind of stuck. And in my personal opinion, we can't tell people or advise people what to do with their 401k unless you're a tax guy, right? About taxes. But we can always just explain the narrative of how we're using it for ourselves and our clients to utilize it today to pay the taxes on the seeds instead of the harvest later on. That's just what I'm doing. So we'll answer some questions on that in a little bit. So now it comes down to these two slides. Would you rather have $1 million today or a penny that doubles every day for 30 days? And this is what I mean with compounding interest. It starts off very little. So it's a short-term sacrifice in the life insurance years, but a long-term gain later on when it starts to compound exponentially. And that's where you see in the 30th day, you got $5.3 million versus the one. And that's what compounding interest means. Uninterrupted compounding interest. No negativity, no zeros, no nothing. It's more of you're always making money as if your savings account in your bank was giving you 4 or 5% every single year to the day you die. And that's what Albert Einstein talked about, compounding interest. If you understand how it works, you'll earn it. If you don't, then you're just going to keep paying it to all the creditors, the lenders, and everyone else of your life. This was the next slide for all the stuff, but Shannon, I'll just let them get in touch with you as far as everything else goes. As far as contracting, if they need me, let them go through you for the channels, for direction. Okay. You and Neil and the team. Sure. That's my 12-minute PowerPoint presentation. I'm pretty quick because most people have more Q&A than it is anything else. That's really just a brief overview of the concept. So if you want, I'll give it back to you, Neil, and you let me know what you'd like to do.
I'm Neil. He's in a tree stand.
I'm sorry, I meant Shannon. I'm looking at your face. It says Neil, and I'm like, I know it's Shannon.
No, I logged in for him to start the Zoom, and then I've got this pretty background because that's where he's at right now. He's up there hunting. He didn't have any service.
Oh, great. He's hunting for leads.
Yeah, he's hunting for leads. So I talk about this stuff on my TikTok all the time, and some of the biggest questions that I get, and something I'm sure people on here are wondering, go back to the very first page where you showed the illustration where you took out that $35,000 loan. And it's kind of crazy. So like I've been doing this for 15 years. You've been doing this for 15, 20, whatever years. And I'll have somebody that's, no offense, we like plumbers. I don't know how to do plumbing, but this one guy was a plumber, and he told me, he said, well, yeah, you borrowed that $35,000 from that loan, but then you got to pay it back. That's what they don't tell you. And you don't have to pay it back, right?
Yeah, technically you don't have to pay back the loans, but you also have to ask yourself, if I own my own bank, or even better, if I own my own sub shop, am I going to go somewhere else? Or if I own my own sub shop, am I going to eat my own product but not pay it back? Am I going to eat myself out of business? If I own a gym, am I going to go work out somewhere else? Am I, what I mean? So it's like, if you own your own bank and you borrow money from your bank, it just makes common sense to pay your bank back, right? You're not going to steal the groceries out of your store from the back without paying for it, because then everyone's going to follow you. So when it comes to the loans, you don't necessarily have to, as long as you pay your premiums, right? So I'll give an example. If everybody sees in year one, you see where it says $16,000, and at the end of year one, it says net cash value, where it says $13,895. If somebody wanted to borrow $10,000 to go pay off high interest credit card debts, like I did for Visa, MasterCard at 30% APR, they can go ahead and borrow the $10,000 out tax-free, pay their credit cards off, and then whatever they were paying to Visa or MasterCard, whether it was $100 a month or $200 a month at 30% APR, they can take the same $200 a month anyway they were going to pay back to them and pay back to the policy, because the loan rates right now with Lafayette Life is fixed at 5%. So if you were going to make the payments anyway, you might as well pay it back and get dividends at the same time. Now, if you didn't do that, if you borrowed the $10,000 and you didn't make any repayment back to the loan, but you did make your premiums in year 2 for the $6,000. And at the end of year 2, your 13.8 compounds to 19.3. Well, now you can't borrow 19,000. You still have a $10,000 outstanding loan, but your money still grew based upon the total. So now you can only borrow 9,000. So you see, as long as you have enough in there and you make your premiums, you can only borrow like a line of credit. So the same thing can be said if you own real estate, or you own a home, or you have equity built in your home, and you want to go remodel your kitchen or your bathroom, and you go to the bank and get a line of credit. You can only borrow what that line of credit is. You can't get over, and you can't borrow more than what you've already borrowed. So the same thing goes along with the cash value. You can only borrow up to that limit, and any monies you borrowed out prior to that, you can only borrow what's left over. So, but the more you pay back the loan, a small percentage or small fraction of that goes towards the interest for the insurance company for lending you their money, and the rest goes right back in the bucket that allows you to borrow more. So that's how it works. As you pay back the loan, you're kind of like paying it back to yourself to give you more availability to borrow again, and the small fraction goes to the insurance company for lending you their money at 5%. And if you never pay it back and you died in year 1, then your beneficiaries receive $300,000 subtracted from your loan outstanding, and that's what your family gets after that.
Good. That's where I was going next. Was all right. So I borrow 35,000 out of that 37,540, and I get hit by a bus a week later. People don't understand why you don't have to pay that loan back ever if you don't want to, and it is because it's collateralized by the death benefit. So instead of getting, let's say, the next year 383, somebody would get 383 minus $35,000.
Correct. As long as you make your premiums, then your death benefit will still continue. And then if you pass away, whatever's left over goes to your beneficiaries after they take the money for the loans that you owe. So it's the same thing as if you own a real estate and your house gets hit by a hurricane and you have no more roof, or something happens to your roof and you got to redo it, and you don't pay the roofer $50,000. Well, the roofer puts a lien on your property, and when you go to sell your property one day, they get the first crack of your money because you have a lien on it. So right. Same thing here. If you borrow money, you owe money to the insurance company. They're just going to take it from your death benefit. So really, you're borrowing a piece of your death benefit early. That's really what they're doing. Like Shannon said, you're using your death benefit as collateral, as you would a house. And the net cash value is the limit you can borrow, like a line of credit, like a HELOC on a mortgage or on the equity of your home. So they go hand in hand. And also, just so everybody knows, if someone did this same example here, this client would have the availability of putting in $16,000 maximum as the cap every year, and this policy would still not become a MEC. So all of this money, they can cap it out at $16,000. But this person, we can design somebody that pays $6,000 a year, which Shannon just did one just now. You can put $6,000 a year and add in an extra $44,000 as another lump sum for the first year. And every year after that, they can cap that at $50,000 without it becoming a MEC every year. So now it's like a supercharged Roth IRA account.
That's huge, because on an IUL, you can't do that because you would MEC the policy. So I like that feature.
Well, it's a good thing you mentioned that. So I want everyone to understand, because when I get some requests in and people write some comments, they're always asking me the differences of those, or can you please send me a comparison? I want to compare both an IUL and whole life. Understand that an indexed universal life and a whole life policy, these are two completely different products, completely. So you cannot compare the two. The IUL is meant for, let's just say, an investment alternative, like a stock or a bond or a mutual fund, where they can't lose, right? Zero is your hero, kind of that thing, like the floor is zero. And you're using it really for a long term, like a tax-free retirement is really what it's mainly used for. Banking is liquidity, which means you need access to the funds. So I know some of these have surrender penalties in the first few years in some of the IULs. And that's meant because it's meant for a long-term accumulation, like a 401k alternative. That's why it's an investment concept. Whole life is a banking concept because there's no surrenders, no fees. So if someone is looking for liquidity and access to cash like now, or they have an emergency, or they have credit card, or they have debts, or they want to buy a piece of property or real estate or anything you want, they want access to their money, then they're more of a candidate for this specially designed whole life policy, because that's the way we can design it so it's not a mech. Okay, so they're completely two different ones. It's like driving a Ferrari and a truck. They cost two different things, and they're going to do two different things. So that's
Right, so
that's
Scott-
kind of the differences.
Scott, can we fund it with a single one-time premium? For example, somebody has money in the stocks or 401k and wants to put it in this product or an annuity.
Yeah, so great question. So when it comes to qualified monies, like a 401k, IRA, 403b, TSP, 457, anything that's qualified, meaning it hasn't been taxed yet, you cannot roll over or transfer qualified money into a tax-free vehicle. Okay, someone has to pay taxes. So, and this is where we tread lightly on the 401k plan or design. Like I'll tell you just my personal stuff, because I'll just tell you me. I have a TSP account because I worked for the government for a few years, and it's a qualified account.
TSP?
Huh?
What's TSP?
A TSP is a thrift saving plan. When you work for the federal government, it's kind of like a 401k. Like a 403b is for teachers, a 457 is for doctors. It's just a code that they use to identify a qualified plan, a taxable deferred contribution plan, right? So what I mean by that, make believe it's a 401k, and I'm gonna cash the whole thing out. So if you break the money and you surrender your 401k, then any dollar amount that you take out, you're going to pay a 10% penalty if you're younger than 59 and a half, and it's all going to count towards ordinary income. So if I take $20,000 and I make $60,000 a year, well, now that shows the IRS that I made $80,000 that year. So that's why you have to get with an accountant before you start taking money or advising your clients to take money from a qualified account, because then you're legally giving them tax advice, and you don't want to do that. So you want to figure out and ask them, hey, look, what's your tax bracket? You can kind of, I can do that for you if you get them on a Zoom with me, or me, you, and Shannon. We can do it all together if we do it as a team. But we can explain to them that if you take the 20,000 out, you may actually be paying 30% in taxes, 10% penalty, 20% income. So that 20,000 is going to cost you $6,000 of fees and penalties, which now nets you $14,000, and that money now can be put into the policy to supercharge it. So you got to tread lightly on qualified accounts. You can't put that into a life insurance contract. Okay.
Okay.
And you mentioned well, you didn't mention it, but if you'll go back to your illustration, if you have like maybe the second or third page on it, I want you to tell them about the net increase.
The which one?
The net increase.
Oh, in the
on the illustration.
Yeah. Okay. So when we're looking at this illustration as an example, there's only two columns, as everyone can see. There's only guarantees and dividends. Okay. There's no averages. There's no percentage that is getting a rate of return. When everyone asks me, what's the rate of return? That tells me that they think everything is involved with investment. There is no rate of return, because rate of return, like I mentioned, has to deal with the markets or an index or anything, stock bond. It has to deal with risk. There's no risk. There's no rate of return. In whole life, the way we design it, it's more of a cash on cash return, or what we call a return on your investment or return on cash. So you're going to receive a dividend, and a dividend you receive. How they come up with the dividends, they take all the premiums and they factor in how much did it cost for the actuaries, how much did it cost for admin, the cost, marketing, and at the end of the day, they wrap it all up. And if there's a profit that the company makes, you get that profit in the form of a dividend percentage, whatever it is. But it's not a rate of return that you earn every single year. It says non-guaranteed because they cannot by law tell you that you're guaranteed to receive a dividend. But Lafayette Life Insurance Company, the reason why we're using them is because they have never missed a dividend payment ever for 120 years. So I think it's safe to say I'm going to get one. And that's why we focus on this column. There's no minutia. There's no hypothetical, there's nothing. This is guarantees and dividends. So this illustration is pretty much going to look like what you see, if not better. Because just to give you a little education background, dividends are based upon the interest rate environment. And as the interest rate environment today is going up, that means our dividends are going to get stronger throughout these next years. If you look back in history in 1980, you'll see that the dividends back then were somewhere close to 8 and 9%. I'm not saying you're going to get that, but I'm saying it's definitely be higher than 5 or 5.2 currently is what it's at. Now, if we look at year 4 in this illustration, you can see in year 4, like I mentioned about that penny that doubles every day for 30 days, the short-term sacrifice for the long-term gain. In year 4, when this person puts in $6,000 in premium, which I call deposits in my new private bank, the $6,000 goes in, you will get your annual dividends calculated in, subtracting your cost of insurance. And in that next column, it shows you the increase in net cash value of $6,054. Now, what that does is that $6,054 goes right into your cash account, and now that grows it every year at a higher valuation on the dividend. Now, when you do that, what I like to explain to the client is every year after year 4, when you put $6,000 in, you will never get lower than what you put into this thing. And let me just say this, in year 5, she puts in $6,000. The increase for that year is $6,423. I don't know about you, but if you can get a 7% return in your checking account when you give them $6,000, you let me know. Or if you can put $6,000 in your 401k without any risk and get a 7% return on that cash, you let me know. You're not getting 7% on every year on the dividend. It's a return on your money. And every year after that, you can see in year 7, the $6,000 creates $7,200. I don't know about you, that's more than a 20% return on my cash that year. You see how powerful compounding is when you don't interrupt it? There's no zero, there's no negative, there's no recession, there's no depression. Your money will grow every single year. This is not an investment. This is an emergency fund, a savings account. This is an opportunity fund, because when an opportunity comes, you have cash to go take it like Warren Buffett does. So if you want to buy a real estate deal and you want to put money, well, now you have an opportunity fund in your policy. You can borrow out tax-free to go get your real estate. If you want to go and pay off credit card debts at high interest rates, you have a vehicle here that you can borrow from and go ahead and pay your credit cards off and pay it back at a lower interest rate. If you want to go buy a car, instead of giving Ally Financial like I have to at 9.25% for 6 years, I can borrow the $25,000 from my policy now next year to go pay off a 6-year car note in 2. And instead of paying my $674 payment to Ally Financial for the next 4 more years, I just pay it to myself because I only have to pay myself 5%. So now I'm a bank, and that's how I want to train everyone else and Shannon and Neil and the team. But that's only putting in 6,000. Can you imagine if I loaded this thing up with 16,000 every year, or 40 or $50,000 every year? So that's the power of compounding interest. When you, like I said, when you understand how compounding interest works, you'll learn it.
Yeah, and we did a client this week that did that. I think she put in $1,000 a month, plus she put in, I don't know, 88,000. So it was 100,000 the first year. And she asked the question, she said, so do I pay on this forever? And Scott's answer was, if you look over here, you're putting in $12,000 a year. And if you look over here, you just got $48,000 that year. So wouldn't you want to give the bank 12 if they were going to give you 48 back? And that's why I love that little column on there, because I've never seen an illustration that had that column on it that explained it like that. So
that's why it's another reason why we like Lafayette. Look, there are other mutual companies out there, like Shannon mentioned. There's Foresters, Mutual Trust, Emeritus. We're never going to get contracted with the 4 major ones like New York Life, Guardian, Mass, Northwest. We're not going to get those. Number one, they don't pay very good on commission anyway, because they don't need our money, right? They're pretty big. But Lafayette Life is also one of the top 5 carriers that we have right underneath them anyway, because they score very high on what's called a Comdex rating, which is a rating scale of all the top major mutual carriers out of 100. Like if you were in a classroom and your teacher gave you a grade and your grade was a 96, that's what Lafayette Life is, an A+ student. Instead of somebody that's a C or a D student, I'd rather follow somebody that knows what to do with their financials. But to piggyback off what Shannon had mentioned, when you get down to that compounding effect, what he's talking about in that client example that we just did yesterday or the other day is when they put $12,000 in, that's not in year 4 or 5. That's like later down the road in year like 20 or 22, like in that penny in day 30. In the 22nd year of that person putting in just the minimum 12,000, that 12,000 is going to create a $43,000 increase that year, which is 3 times their money. So would you not put 12,000 into Bank of America if that bank was going to give you 40 grand for your 12? And the reason is because at that point in time, her cash value is like $500,000 or more. And now the dividends are credited on that number, 500,000, not 5 grand, 500. And that's why she's getting that increase.
So Scott, is there a minimal and maximum amount that we can sell people?
Yeah, so I recommend, in my opinion, like number one, this isn't for final expense clients, and it's very tough for a 55 or 60-year-old to put, let's say, $300 or $400 a month into it. Because if you're 60 years old or in your 60s, you're basically retired. Like you're not going to work forever, so you're not going to put money into this thing. So it doesn't really work that well for someone who's in their 60s that only wants to put $300 or $400 in. But I have a doctor that's 61 years old that's going to work for the next 10 years. He's going to put $50,000 in for the next years, for the next 10. That's a $500,000 in 10. I can work with that. Like he can do that. But I'd say the minimum for someone starting off just to kind of get things going is around $250 a month, in my personal opinion. Maximum, it doesn't matter. You put sky's the limit. It doesn't really make a difference. I got a guy that's putting in $1 million a year. It really just doesn't matter. Now, there is a certain guideline that we have to, follow, because we don't want these things to be a mech. And because the rule 7702 came out, the code of the IRS, we have to stay within those guidelines. And that's why they have what's called that 7-pay test or 7-pay mech test, modified endowment contract. And the reason is for some people on here who don't know, when you have too much cash building more than your death benefit, they consider that an investment, not life insurance. And this is not an investment. So we have to make sure to stay underneath those guidelines. So the way that we design a whole life that's completely different from the IUL, which is definitely what separates them, is we design the whole life in 3 different parts. The first part is the cost of insurance part, which if someone's paying $3,000 a year, we split that cost off where 50% of that money goes towards the cost of insurance and the extra 50% goes right towards their cash account. Okay. So when we are talking about commission, because it's going to come up anyway, Shannon, when it comes to commission in a whole life, your comps are cut in half, because now we as agents are giving up half of our commission so that our clients can have more access to their money. And trust me, when your clients have access to money, they're going to tell other people, and now you're going to get so many more referrals. That's number one. Okay. Number 2 of the design is we are able to put a term policy, or a term rider, they call it, right inside of a permanent policy. So it's a whole life policy till age 120. But in order to get enough death benefit to justify to the IRS, we have enough coverage. So it's not a modified endowment contract. Instead of that client paying full price for the traditional whole life, like Dave Ramsey talks about, we can put a 7, 10, 15, 20, or 30-year term policy right inside of a whole life for a fraction of the pennies. That's how we do it. So that's how we design the rest of the money goes into the cash account. So if we want to get more into the design, when you guys get your license numbers, Shannon and I or Neil and everyone will get on another call and we can send you a video or do a presentation for you about how to design these.
Just one more question. Yeah. So if the cash value is building up rapidly and then it's getting to the point that it's going to be more than the face amount, then there's minimal distributions that they have to take.
No, we already designed those policies where, I'll give you an example. If someone puts in $250 a month, let's just use that, $250 a month, $3,000 a year. I just designed a policy right now for $3,000 a year and giving them the ability of putting an extra $27,000 as a lump sum throughout 12 months. That's a total of $30,000. That's the guideline that we have to stay. I use about, let's just use 7-to-1 around there. So what I mean by that, if someone's putting in, or maybe 8-to-1, if someone's putting in $3,000 a year of premium, we can design this policy to give them an extra $27,000, right? 8 times 3 is 24. Like, we can build it up where they can put an extra $27,000 into the policy, and it's not a mech. So you have to have a minimum premium and then upwards of a maximum availability, which the software tells us whether you can and can't do that. So it already knows that you can't put in $50,000 and only put in $50 a month. Like, it knows
The
already
software
what
won't
your
let you.
minimum premium needs to be.
Yeah, the
Makes
software
sense.
won't let you mess it up.
Yeah, it won't make you mess it up. It tells you it's already designed that way. So,
And then Federico had a question.
sure, you can just
Yes, so I'm newer to all of these, so if I'm wrong, correct me. When you were showing the dividends part, you mentioned the interest rate going up and therefore increasing the dividends. What happens if the interest rates go down?
Well, the interest rates have been low for the last 12 years, and they've never gone below 5.2% of their dividends.
Okay.
So, and you're getting guarantees. I already looked at a contract last night. I think even the minimum the lowest I've ever seen was like 3% total of the minimums, like the bare minimums, which is we're not beating the markets. This, please, it's not an investment, guys and ladies. This is a banking alternative. As if your money's sitting in the savings account at Bank of America, earning you nothing, doing nothing. You're letting the banks use your money and making 1,000 times more than what you have in there and giving you nothing in return. I give you an example. If you have 50,000 sitting in your bank account right now, your savings account, doing nothing, and you want to go buy a car for $30,000, the bank's and you got a loan from the bank instead of using your cash, the bank's basically giving you your money, charging you a 9% or 8% interest rate, and then you're paying the bank right back and you're getting less than 1%. That's literally what you're doing to the bank. They're just lending you your own money back, and they're making money twice. They're using your money and they're lending you your money, and they're getting the spread, and you get nothing. So now you get a chance to use this like you are the bank, get it away from them, and put it into a policy where you control it with no risk, no volatility, nothing.
Good deal. And then another question. You mentioned Dave Ramsey. I saw a podcast he did where somebody called in and said, hey, my financial advisor, life insurance guy, whatever, is telling me that I should do this infinite banking concept. And he said, oh, what a bunch of crap. And I know he doesn't fully understand the intricacies of how this works on the back end.
Definitely.
But essentially, he said all an IBC is where you're overfunding a policy and then they're giving you a refund. So can you, in case we get that, what do we say to that?
Yeah. So what I always tell people, number one, is don't let Dave Ramsey fool you. He's had a Mass Mutual policy. So he has a whole life policy. Don't let him fool you. He just won't tell you that. I have knowledge of that. So, but anyway, I would tell him, look, Dave Ramsey, number one, is trying to sell content, and he's not going to change the narrative of what he's built for the last 30 years or whatever it is on TV. He's not going to change his mind. But I usually say, look, Dave Ramsey is talking about your traditional whole life, like back in the day when your $10,000 premium is paying 100% towards the base, all going towards the cost of insurance. Okay, that's what it is. The way we design these whole life policies are completely different from the time of old. Okay, we design them very specifically where it's tailor-made to the client. Okay, that's number one. Number two, what he's talking about, the dividend as becoming your own return of your own premium, that's because the IRS has classified that and deemed it that way. And the reason why they did it is for who? It's for the banks, politicians, and everyone else. Who do you think wrote that in the IRS code? The people that are using it and abusing it. So if they created it for themselves and called it a return of your premium and they itemized that as tax-free, that's why they did it. He's not going to tell you that, but that's why they did it. So if it's a return of my premium, it doesn't matter. He could have said it's a return on profit, but if he did that, you'd have to pay gains on a profit. So
Right.
that's why he said it's a return of your premium. And that's why the code is in there. And that's why it's labeled that way, because it's tax-free. I don't care how they label it. If it's tax-free, just give it to me. So that I always tell them about that with the Dave Ramsey question. But anyway, that's how I answer it.
And I had another
And
question
yeah,
myself.
I'm sorry. And Dave Ramsey does say, well, I don't see the value of borrowing money from yourself and then paying yourself back and charging you interest. Let's understand this. You're not borrowing your money. Okay. You're borrowing the insurance company's money, because if you're borrowing your money, that means your money goes down in the cash value. Your money is staying right there, earning the dividends on the full value, and you're borrowing the insurance company's money as they charge you an interest rate. You pay them back the interest. Because if you borrowed money from a bank, who the heck would you pay the interest to for lending you money? The bank. The difference is you're not getting anything in return. There's no dividends. So I'll make two things known, which y'all can rewind this video and understand the reason. Another reason why we went with Lafayette Life. Lafayette Life Insurance Company is called a non-direct recognition company, which is very different from something called a direct recognition company. Whether it's a IUL or an index or a whole life or a UL, VL, whatever it is, whether it's a stock company or mutual company, you have to understand the companies you work with. Lafayette Life is a non-direct recognition. What that means is when you borrow money as a loan, they do not recognize that loan outstanding, which means that's why you're getting the dividend on the full value. A direct recognition company means they directly recognize the loan outstanding. And now, if you have $50,000 in your cash value and you borrow 40, you may only get credit on 10 because they directly recognize the loan. Now, I'm not saying that's every company. I'm saying some companies give you your credits, whether it's an index or a dividend or a sub account in a VUL. They all give these things differently. You need to know what you're offering your clients and how that company is operating in the form of loans, because that's really what we're doing for clients. And that's another major reason why we're using Lafayette Life Insurance Company. We've done all our research. AMS and Sean Ruggiero and that AMS team, they've done extensive research to find you guys and our team the best mutual carrier for us. So
Good deal. And
Yeah.
then in your presentation, you mentioned 500%. There was a slide that said 500%.
yeah.
Can you go to that and explain what that was?
Yeah, sure. Where is it? Sorry. Wait, is that it? Wait, where is it?
Towards the beginning.
Oh,
Yeah,
here it
right
is.
there.
Yeah. So basically, if you add the spreads together, right? If you're earning, I mean, I was being very generous in this bank. I was saying
Right.
this bank was going to give you a 4% return in your savings, right? I mean, if this was back in the Carter years, you were probably earning this, but the interest rates were like 18%. So what I'm saying is if the bank was giving you 4% in your savings account, but they were lending your money out at these percentages, earning the spreads, if you add those spreads up, you'll see that they're giving away 500%. They're earning a 500% return than your money at 4.
Yeah.
That's what they're getting you. That's the difference. When you average those spreads out, it comes out to a 500% gain that they're making on your money on that spread. That's what that means. So I'm teaching agents, clients, that if you're earning 1%, can you imagine what this looks like?
Oh, definitely.
I mean,
Well, I asked that question because I had somebody on my TikTok. I had something similar to this, and they said you can't just add up all these and make it a percentage. You have to. They try to be mathematicians and explain to me how you add all these up and you take the average of them and blah blah blah. And I'm like, you're missing the point.
yeah, because they're more analytical and they want to find problems with something instead of finding the solutions. And when people try to get more into the minutia of the numbers, then
Right.
they're not going to sell anything. Because when you get too bogged down with numbers, see, guys, understand, we don't sell based upon numbers. Okay, it's that phrase I was told a long time ago by very, very wealthy people: facts tell, stories sell. Okay, you don't sell on facts, you sell on stories. Just like I created all these stories for you and how to utilize this money. Right. So I create stories. I create the narrative like, hey, look, whatever they come from. What do they do for a living? Are they in real estate? Do they want to do real estate? Do they have a car? Do they have a trucking company, a plumbing company? Like, what do? They invest in crypto. They invest in the stock market. I'm using whatever their hobby is or whatever they have going on. You have children, great. They're going to go to college. Like, I use whatever stories that they have or whatever their lifestyle is. I use that and create a story. So if they own a trucking company, or I give them an example. I usually use a guy that owns a trucking company. And I say, look, I got a guy that owns a trucking company. And instead of his $100,000 sitting in his business account right now doing nothing, when he wants to enhance his trucks, he either uses his business credit card or asks for a business loan, or he uses the cash in his business, in the money market account of his business. I tell him, what if you use the $100,000, put into your policy, pay at least $12,000 a year minimal to design that plan, and then right away within 30 days, borrow $60,000 tax-free and go enhance your trucks. Go buy your 2 new trucks. And now when you pay that money back to the insurance company for lending you the money you were going to get anyway from a credit card or a bank, I said, you're just going to make profit from the movers, from the business. And now you can let that business pay back the loan. And at the same time, your $60,000 inside your whole life policy is earning dividends on the full value. So now you're earning dividends on the full value. You're buying trucks to enhance your business to grow for income, and you're leveraging it by borrowing the insurance company's money. Same thing with real estate. If you have people in real estate and they sit on a lot of cash, and when they buy a piece of property, or they use their cash in their bank account to put down 20% to the bank to get the loan so they don't pay PMI insurance or private mortgage insurance. Let's just say you have $300,000 property you want to buy and go get a tenant for rent. Well, you want to put 20% down. You might as well go ahead and put that $100,000 in your policy, and then you can borrow the $60,000 out tax-free from the policy to go give to Wells Fargo. And now when Wells Fargo has your $60,000 that you borrowed from the insurance company tax-free, you got a tenant in there, and that tenant, you charge $50,000 a year, and that $50,000 a year from that tenant's going to pay back the loan to Wells Fargo and the loan back to Lafayette Life. And at the same time, you got an asset that's appreciating. You have your policy that's growing on the full value of the dividend, and you've borrowed money 2 places to go get an asset that's going to create you residual income, passive income for the rest of your life once that property is paid off. And you keep doing this over and over again. You can build a rental property enterprise by the time you retire. So a lot of different things you can do with this policy, no matter what. Crypto. I got a guy that does crypto, right? Instead of spending $50,000 on his Bitcoin, I told him, stop doing that. Put the $50,000 here, pay $5,000 a year, whatever he wants to do, $6,000 a year. I said, and then take out $30,000, $40,000 immediately within 30 days, go buy your crypto. And when Bitcoin goes up, sell whatever you need, pay back the loan, and now you got house money. So whatever you want to do.
Good deal. I appreciate all that. And then you had also said you can take distributions from this, like kind of like on an IUL, how it shows here's the distribution. On an IUL, I know that distribution is a fixed loan, so it's not reduced from the death benefit when you die. And it's also not a loan that's ever expected to be paid back. So is it the same here? And how can I show that on an illustration?
Well, when it comes to when it comes to the IUL structure of seeing the income for the rest of your life, we still have to understand that even when we stop the payments at age 65 with the IUL, that doesn't mean the cost of insurance stops with it. It still means you got to pay because the IULs are still annual renewable terms. That's really what it is. So every year when you stop at age 65, from 66, 67, 80 years old, you're still going to have to pay the cost of insurance based upon your age. That's how it works. So when you start taking income, still understand from that perspective is if you're taking out $50,000, $60,000, $70,000 that you see on the illustration, the cost of insurance is still going to have to be drawn out from the cash value. So you're taking loans, you're taking the cash value, right? So it's both reducing, but at the same time, your index does need to perform at a specific rate of return on that index in order for that thing to last the rest of your life. So that's one of a number we may or may not know in the future. Yeah. Whereas with the whole life, we will design it based upon, I'd say, more certainty, because there's no index performance that I have to illustrate. It's just based upon the dividends you receive. Because remember, it's only guarantees and dividends. There's no assumptions. There's no hypothetical assumption of what you could earn with a specific stock, bond, mutual fund index. Okay. So what you're going to do later on in life is when you do the same thing about taking income at age 65, when you, what they call RPU, when you reduce and pay up the policy till age 65, that is it. There is no more cost of insurance. It doesn't increase. It's like final expense. When you guys sell final expense, it's level death benefit, level premium. The cost of your insurance is the same whether you're 20 years old or 120 years old. It doesn't matter. So when you stop the payments at 65 and you start taking income from the whole life at 66 till age 90 or whatever, let's say, those numbers are going to be pretty much concrete that you see. There's no minutia. Okay. There's no worrying. That's what it's going to be. It's going to be pretty much similar to that. You know what I mean? So those are the differences. One is more of, this could be what it is, which if you look at them side by side, which I'm telling you, you can't do that because the IULs, I'm going to tell you, are going to look better than anything because that's what it's illustrating. I'm just giving you the narrative. You can't compare the two.
Gotcha. And then, also guys, just, we say this about every week, but you can't just stop doing what you're doing and go hunting all these, big white elephants, as they say, because like I started doing these. I mean, I did these 10 years ago or so, but my last company, they didn't offer anything like this. So I came on board with FFL. I did the lead thing. I did final expense. That's how I made my living, was going out and helping families just like everybody else does. I bought the leads, I called the leads, and I wrote them whatever they needed. But I started doing this earlier this year. And I think my first one took 3 months to issue. So, and I think especially nowadays, a lot of people see the market crashing. They're losing their mind about how much money they're losing in their 401k and their Roth and whatever else. And they're looking for somewhere else to put that money that is safe. Like Scott's saying, this is a guarantee in dividends. So you got to think that's a lot of just overwhelming the crap out of all these companies when it comes to underwriting. I know, one of my carriers just hired 16 new people to help with underwriting to help get things approved. So just don't think that you write a policy today, you're going to get approved tomorrow and paid the next day, like a Mutual of Omaha, return a premium 30-year term or something. You need to keep doing what you're doing, but also ask that golden question of what do you have that acts like life insurance? That's how I uncover a lot of these is what do you have that acts like life insurance? And I think that question is asked to be kind of confusing on purpose because I know when I ask it, I don't really expect them to answer. I want that hesitation so that I can throw in some ideas. I say, Scott, what do you have that acts like life insurance? Like a 401k or a Roth or money in savings. Like if somebody died tomorrow and you needed to come up with 20 grand, where would you find it?
Yeah, that's great. Hey, he's right. And Shannon's right. This isn't meant to stop everything you're doing to go find these people for infinite banking. This is, you still got to pay your bills. You still got to create revenue for yourself and your family and for your business. So you still got to stay on track with the final expense, mortgage protection, leads, and still go out there and make your money. That's like feeding you now. This is like when you have time, if you get one for yourself, which I highly recommend, because how can you sell something you don't have, for yourself? Even whether it's $250 a month, you just got to start and see how it works and then use it yourself and you'll be blown away like I have, because I already used it to pay off my credit cards. I put in 26,000. I borrowed 22. I paid off my Macy's, Home Depot, Amex City card, half of my MasterCard. And now instead of paying $800 a month to American Express at 25% APR, I just pay back $800 a month to Lafayette Life because they only charge me $5. And my money's still growing at 22. So these things take time. These are fully underwritten policies. They do blood, urine. They check your motor vehicle records for any DUIs, felony, misdemeanors, any revocations. They're gonna order your medical records from your doctors. They're going to get a prescription check. It is a fully functioned process. So it can take 7 weeks, 8 weeks, 2 months. I have one that's going 3 months just because the doctor's not cooperating in the doctor's office for medical records. So this is like Christmas in July when you get them. Like when you get them, they approve, boom, you got paid. And, these aren't going to charge back because people have money. Like this is not something that, because they're not going to go through a lengthy process and not pay. They're not going to cancel it, So this is like maybe some friends, some family, some people, and And when you understand how to create content like Shannon does, and maybe you just get leads that just flow, or when Shannon gets overfluxed with the leads, he's very generous. I've seen in the past, he'll go ahead and help his fellow members out that are actually producing and not sitting on their ass, doing nothing, watching TV. I think Shannon's very polite and generous of giving leads away to people that are working. I think I've seen that before.
That's right.
So, yeah. Any other questions?
Cool.
I guess there's a lot of chats. I don't know who's chatting.
Yeah, I've been asking the chat questions. The last
Yeah.
one I answered, we'll make sure I was right. Said, so you leverage the insurance company's money tax-free, that doesn't affect the cash value, and it would draw from the death benefit. Question from Jordan. I said, correct. You're borrowing technically a loan from the insurance company. Your money still sits there and grows. And if you die before that loan's paid off, then they just reduce the death benefit by the loan amount.
Correct. They work the same way. Now, you don't get both columns. Okay, you don't get the death benefit and the cash value. Some people have that question too, because we're not designing this for death benefit. When you see that illustration before, we're designing it for the lowest amount of death benefit we can possibly get, so we can maximize the cash like a bank does on their executives. That's why we design it. So when you put in a request either to myself at Ask the Specialist on HCMS or Chimes or whatever it is for infinite banking, or if you give it to Shannon to run something, don't give it to him saying, well, the client wants $500 a month and they want $1 million death benefit. Don't do that, because it's not designed for death benefit. We want to explain the concept. What I recommend to all the agents on here, I don't expect you to answer all the questions to your client that asks you, because then you don't have the answers that they're asking you. You want to look smart. What I explain to all the agents I talk to is, look, leverage myself, leverage Shannon, because that's your contact. I would say your point of contact. I would say go ahead and just create the narrative, create the curiosity, dangle the carrot, and then pull it away from them. Explain to them just the bare bones concept of how to utilize infinite banking, and then let them know, look, if you have any questions, my role in this to see if you're interested. And if you are interested, then I can put you in contact with the expert, Shannon, my expert in this industry. He's been doing it for many years. You don't have to say 1 year, just many years. They don't know. And now you can go ahead and leverage him. And now you've eliminated answering any questions. You're done. And just say, my role is to get you in touch with the expert Shannon we have in our back office. He's the one that can design, answer questions, explain to you, answer everything for you, and go over how to design them. Let's just get you on a Zoom with Shannon, let him show you how it's done. And now you completely eliminate yourself from answering questions you don't have the answers to. Don't try to do it yourself. I'm telling you, you'd rather give a percentage to Shannon to help you do it, right? A little split commission like I give to some of the agents to do, to teach you and train you. Okay, leverage us, create value, make money by sitting there and just taking notes.
And that's pretty much what I do. My first meeting, I just tell people, listen, my first meeting, I know we booked it for 30 minutes. It's really designed for you to ask questions, me find out what your goal is, me to find out what you expect this to do for you. And really, I'm just trying to get information like how much money they want to contribute to it. If they have a lump sum amount they want to put into it, what's their age, what's their state, all these different things. And then I tell them, I'm going to go create you a customized solution. And then we're going to get back together for about an hour. I'm going to get you on my Zoom and we're going to go through the illustration. That's when I'm going to answer all their questions. I just tell them up front, like that, this is how it works. Like Paul always says, right? I'm the doctor, you're the patient.
There you go. That's true. That's what it is. You're the financial guru for, it's kind of like going to the doctor, like you said, and trying to get a diagnosis. Like you shouldn't be missing these appointments. You should lock them down. When you set an appointment for Shannon or myself, you need to lock it down and tighten that appointment up and edify it where they're so busy that you're lucky enough to even get 10 minutes of our time. And that's how important this is, because the client's not going to miss the doctor's appointment if they have gangrene on their toe. So why the heck would you miss this appointment? This is a financial medication. So don't miss the appointment. Lock it down. Make sure that it's edified enough, because nobody likes no-shows or wasting time. So.
And when you do go to FFL AMS and you click that
Ask a Specialist.
Specialist, thank you, it does go directly to Scott. So if you click the one for IBC, it goes to Scott. He'll be the one that's actually building the illustration for you. So, and I think that's a less than 24-hour turnaround. He's pretty quick.
Yeah, I got, I'll just put it right here. This is, you go to fflams.com and ask a specialist. If you guys need me, this is my email address. Scott at FFLAMS if you need something. I don't really give my calendar out a lot, unless you have pretty much business at this point, because I do 7 Zooms a day. So it consumes me, but I have a lot of agents that I reserve spots for business. If you want to do business for yourself, you have other business. And first, I would say, please use your contact for Shannon and Neil. And they're already up to speed. Shannon is like right there. He's designed his policy himself today. Just had to help him a little bit with it, but he's right there. He knows. And I'll go from him first. And if that's the other case, and you need my help, just get with Shannon. Shannon will point you in my direction, and then I'll be able to help you guys as well.
Awesome, Scott. Well, listen, thank you so much for being on. We greatly appreciate your time. And guys, I think that's about it for today. In case unless anybody has any extra questions, I'll see you guys back here at the same time next Thursday. Everybody good?
Yeah, we're good.
Good. No more
Scott,
questions?
yes, just one more quick question.
Sure.
When it comes to illustrations, are we supposed to go over the illustration in detail with the client, or just
On
Yeah,
your
good
first
question. Yeah,
one, I
so-
would get on a call with me or with Scott and have us walk through it so you can see it. Because I know what I say, and I had him do one for me this week, and I learned a lot by watching him do it. Like, I think he explained things in greater detail than I do, and I took a ton of notes. So I would have one of us get on there with you and do the first couple.
Yeah, there's 1 or 2 things, and then I guess we'll let you guys go. First and foremost, if you don't understand how to show the illustration, like really articulate the benefits of how we do it, because there's a certain reason and pattern that I work through the illustration to point out and highlight certain things and to segue from any rebuttal that they have of some question, which Shannon is picking up a lot more detail because he takes good notes. But he's so right there. I don't suggest you do the illustration example with them. That's number 1. Just let Shannon or myself help you do that. Just leverage us first. And number 2, whether you guys are doing this or not, you don't have to take my advice or not, but I'll give you a little friendly advice as an advisor for 15 years that I've learned hard. I do not ever give anyone, any prospect, any illustrations. Oh, can you please send me this so I can look at it? No. And I don't just say it like that. I say, look, I don't do that. But in my mind, I'm saying that. But in reality, I go, hey, look, Dick, I just want to let you know, and no disrespect, I don't tend to give the illustrations out to people. And let me explain why. That's how I say it. 1 of 2 reasons. 1, if I give you the illustration and you don't really know what you're looking at, it doesn't make sense to you, then why am I going to give it to you? You're not an expert. We're the expert. We're licensed. We're here to show you this. And 2, what you're going to do is something you may or may not understand is you're going to give it to a friend, a neighbor, maybe an advisor, someone that you had in the past that's an insurance or financial advisor you work with, or a broker. And I know you're going to do that. And that's okay, because you're curious to find out another opinion, which you can. And when you do that, what they're going to do is they're going to then tell you 1 of 2 things. Either this is terrible, why the heck would you do it? Or B, hey, look, that's great. We've been friends for 50 years, Dick, since little elementary school. We can just do it together. And now we work so hard to put the value and effort in designing this for someone, giving them the idea just so somebody else can make money. So I say, look, Dick, we're just not in the business of doing that, because I tell people, look, we're here to make money. We get paid for the value we provide. And when you become a client of ours, Dick, guess what? We take care of you for the rest of your life. So we have to earn that trust over time. But if you really need to get the information, what I suggest you doing is go back to the person that you were going to show this to anyway, and go ahead and ask them to present you the same thing, $500 a month, $1,000 or $2,000 or $10,000, whatever lump sum. Go get one from them and bring it back to us if you can get their illustration, and we'll match it side by side. We're happy to do that. But if not, what I suggest we do, because a lot to retain, let's get on another Zoom next week and we can just go ahead and review until you're comfortable. But they don't get any of mine, whether it's an annuity or whether it's life insurance, they get nothing because they're not going to do it with you anyway.
Right, but with the annuity or the life insurance, when they get the policy or the annuity, the illustration in there, isn't it?
That's correct. But let's put an application in first before I just give you
Right.
something before you know, let's dance. Like, let's have some skin in the game, you know? So I'm not going to, I've gotten burned so many times by giving someone a $300,000 annuity presentation for one of the companies, a fixed index annuity. And I never hear from them in 2 weeks because you know why? They gave it to a friend, right? At Fidelity or Schwab, or a friend of theirs that works at Merrill Lynch, and I'm gone. And they always give you the same phrase. So if you haven't heard it before, listen hard because you're going to get it. No, we thought about it. If they get you back on the phone, we thought about it. It's just not for us right now, or we're going to think about it, or they ghost you. That's the polite blow off to say, look, we appreciate what you gave us. We gave it to another friend and we're going to do it with them. So don't give away your golden goose. Don't give them money that you worked hard for. Okay. They don't understand it. So don't give it to them. You know, so just make another appointment with them so you can go over it again until it makes sense. And then they put pen to paper. That's just my 2 cents. You guys don't have to follow what I'm talking about, but I learned the hard way for 15 years. So anyway, I appreciate you guys. Shannon, you're on mute, by the way.
Oh
Neil's.
yeah, thanks.
So
It just
I
popped up and
appreciate
told me I
you.
was-
Yes, okay. I appreciate you. I appreciate Neil. Appreciate your team. You guys are awesome, and I can't wait to see how far you guys go. I think you guys are coming up on. We'll get you to $1 million a month soon.
Awesome.
Anyway, we're happy to help you as much as I can.
All right, buddy. Thank you.
Thanks for
Thank you,
everyone.
Scott.
Thank you guys. All right,
Thanks,
take care.
guys. See ya.
Thank you.